Welcome back to the Deep Dive. Today, we're taking a really critical look at how a major real estate innovator is trying to navigate what is genuinely an uneven housing market. You're actually skipping the prepared remarks entirely today.
Good call.
Yeah, going straight into the fire. The detailed Q&A session from Offerpad's Q3 2025 earnings call. This is really where the strategy gets tested,
That's absolutely right. I mean, the source material captures a company smack in the middle of a pretty high-stakes strategic pivot. It's necessary, but risky. The housing market is, well, challenging, let's say, and management is aggressively shifting away from relying just on that traditional single-path iBuyer model.
Right.
They're scaling diversified services while at the same time executing some pretty brutal cost-cutting. So our mission today is simple: to really understand the intricate strategy they need to hit their intermediate-term target.
Which is?
1,000 real estate transactions per quarter. That's the magic number.
Yeah.
And by doing that, getting back to profitability.
And those analysts, they weren't just taking the ambition at face value. They were focused on the execution, right?
Exactly.
The essential questions, they really boil down to, well, three things. How are they physically scaling these new sort of asset-light services? What's the exact product mix that finally lets them break even? And maybe the most compelling detail, I think, is how does technology enable this massive transition without just, swapping fixed costs for variable ones?
Right. And that anchor metric, the one you really need to hold on to through this whole discussion, is that 1,000 transaction goal. Management was explicit. That volume, it's the non-negotiable foundation for being profitable again.
And where were they at the time?
Yeah.
Just for context.
To put it in perspective for you, at the time of the call, they were tracking around 500 total transactions per quarter, give or take.
So halfway there.
Halfway there. So we're basically analyzing the playbook for doubling their volume, while at the same time fundamentally changing the nature of the business itself.
Okay, let's unpack that core strategic shift straight away then. The questions from analysts, like Daly from JP Morgan, they really focused on those three new asset-light pillars: Home Pro, Renovate, and Direct Plus Cans. We know they're moving away from just the cash offer, but what's the specific upside they see for these new programs in 2026?
Well, management's focus seems singular. It's all about conversion. CEO Bair, he really emphasized that they have to capture the seller, basically regardless of what they initially want. The goal is to maximize the chance that any seller who interacts with Offerpad eventually transacts with them. Doesn't matter if it's a cash deal, a listing, or maybe just a service.
Okay, so take Home Pro. That's their agent-led listing service, right?
Right.
It sounds like it's all about flexibility there.
Yeah.
Giving sellers the cash offer option, the listing opportunity, maybe even getting bids from other cash buyers. It's that meet them where they are kind of approach.
Exactly. And the growth of the other two, Renovate and Direct Plus Meander, well, that's tied much more directly to the health of the, let's say, the institutional housing market. As things stabilize a bit and maybe other cash offer partners start buying again, you see two things happen at once. Direct Plus Meander, which is selling their inventory off to institutional buyers, that expands. And Renovate, which is providing renovation services to those diverse customers, sees higher demand.
So Renovate becomes this incredibly resilient part of the business.
Yeah.
I mean, the fact that it hit its third consecutive record quarter, even during the really tough market conditions, that proves the value of selling services, independent of carrying all that inventory risk.
And that resilience, that's what drives the critical financial pivot, the mix shift. Right now, their real estate transaction mix is roughly 1/3 asset light and 2/3 cash offer.
And the target for 2026, is it just flipping that?
Essentially, yeah. The plan is to shift that mix to over 50% from asset light products sometime next year. But here's where it gets really fascinating, analytically speaking. Management views the gross profit from cash offers and asset light real estate transactions as very similar.
Okay, hold on. If the gross profit is very similar, that changes the whole risk calculation, doesn't it? Why wouldn't a service model, which obviously carries less inventory risk, generate significantly higher margins than the traditional iBuyer model?
That's the critical question the source material sort of implies, right? If the margins are similar, it suggests one of two things. Either Offerpad has managed to dramatically streamline the cost of capital and the holding costs for its cash offer business.
Which would be impressive.
Very. Or the operational complexity and the servicing costs of those asset-light services, the Home Pro agent commissions, the tech overhead, maybe those are higher than a simple transaction fee might suggest. But regardless, the strategic takeaway is clear. Because the economics are viewed as similar, the scaling effort now rests almost entirely on conversion and volume, not really on margin arbitrage between the models.
Okay, that reframes the whole effort. It's about the width of the funnel, getting people in, not just the, let's say, quality or profitability of each path.
Right.
But we can't just forget the foundation here. The CEO is still very clear that despite this huge diversification push, the cash offer is still, in his words, the best product in real estate.
It has to be the anchor product, you see. It solves the biggest friction points for sellers, speed and certainty, and it's the primary way they capture that seller initially. Then they can offer this menu of options within the Offerpad ecosystem. It's the highest friction product, sure, but it probably generates the highest quality lead to start with.
Right. But, talk is cheap. If diversification is the strategy, the analysts rightly wanted to know, how are they actually going to execute this high-touch home pro channel? I mean, it involves agents, home visits. How do you do that without bankrupting the company on new headcount?
This is where the technology pivot becomes the operational engine. Management stated they plan to grow smarter, basically leveraging data and automation. The headcount needed to scale home pro, they say, will be mostly external, the agents, the home pros out in the field. Internal operations have to absorb the volume increase using technology.
Okay, so what's the tangible tech detail? What proves this is more than just, a buzzword?
Well, they're attacking what might be the most manual, subjective, and frankly variable process in the whole transaction. Inspections and figuring out renovation costs. They're planning to launch the first phase of AI-driven picture recognition and smart scoping technology by late this year or early 2026.
Okay, AI picture recognition. What does that actually do?
This system analyzes photos of the house, automatically identifies condition issues like a leaky faucet or damaged drywall, and then estimates the renovation needs.
Wow.
And that data feeds directly, automatically into their pricing model.
The real win there isn't just speed, though, is it? It's consistency. That's fundamental for a reliable pricing model.
Exactly.
Inspection variability. I mean, one inspector flags the roof, another ignores it. This is a killer for scaling accurately. The AI basically tries to eliminate that subjectivity you get with human inspection reports.
Precisely. And that automation, it doesn't just reduce internal expense, hopefully. It dramatically speeds up the process of giving a final, certain cash offer, which, directly addresses that certainty friction point the CEO keeps mentioning. It ties the whole funnel together faster and ideally cheaper.
Okay, looking at conversion then. Did management offer any insight into how sellers are behaving in this, high-rate, tight mobility environment? What are the current trends?
They did note that in the current tough market, they're actually seeing more people choosing the cash offer over a traditional listing.
Interesting. Why is that?
It suggests that when sellers are facing complex life moments, maybe relocating fast for a job, or high rates limiting their next purchase options, the certainty and the speed of a cash closing often outweigh trying to maximize every last dollar on the list price.
That makes sense. Speed and certainty become paramount. Okay, before we move on to the financials, let's quickly address the elephant in the room regarding the metrics. Why is Renovate excluded from that 1,000 transaction goal, even though it's profitable and asset-light?
Yeah, that's a good question. Management's rationale is actually very specific to their business strategy. The 1,000 transactions goal, it focuses specifically on real estate transactions, so buying and selling homes. That metric tracks capital velocity and the core real estate gross profit. Renovate, on the other hand, is categorized more as a related business or simply service revenue.
So it's incremental profit but not core volume.
Exactly. It helps the bottom line for sure, but since it doesn't necessarily involve Offerpad facilitating an actual home transaction, its economics are tracked separately from that main volume target.
Got it. So real estate transaction equals volume and capital risk. Service revenue is incremental, low inventory risk profit. Makes sense to separate them for goal setting.
Right. And shifting gears slightly to the Direct Plus side, that's their bulk selling channel, they did note that the big five single-family rental buyers, the huge ones, are still mostly sidelined, not buying at normal volumes.
So how are they keeping that critical channel flowing then, if the big guys aren't buying?
They're broadening the funnel significantly. They're expanding their Direct Plus buyer base to include more diverse, maybe mid-tier funds who might only focus on one or two specific markets. And crucially, they're also adapting their own appetite for inventory. They're evaluating new segments of properties they previously wouldn't have touched.
Like what?
Like, more as is conditioned homes or homes that are hard lived in, as they put it, homes needing more work.
So more flexibility on condition.
Yeah. This flexibility ensures they can quickly monetize homes that maybe don't fit the standard lighter touch flip profile. Keeps inventory moving.
Okay, now let's connect all this operational detail back to the ultimate prize. Profitability. Michael Eng from Goldman Sachs really zeroed in on the financial requirements.
Right, and achieving that 1,000 transaction volume, it relies just as much on aggressive fixed expense control as it does on the volume itself.
We heard a pretty staggering number there. Management stated they've removed about $150 million in fixed expense annualized from operations. That's profound.
It's a huge number.
What does a cut like that actually look like in the quarterly numbers? Can we see it?
Yeah, the proof is definitely in the execution there. Operating expenses, if you exclude the property costs, dropped sequentially from $16 million down to $12 million in Q3 2025.
Wow, $4 million just quarter over quarter.
That relentless sequential drop, that $4 million, it demonstrates they are absolutely executing on that $150 million annualized goal. Hard.
That's a 37% year-over-year reduction in OPEX. I mean, cutting $150 million is impressive. But is there any risk they cut too deep? Like into essential functions, customer service, critical tech development things they actually need to hit that 1,000 transaction volume in 2026.
That's always the risk with deep cuts. But management was very clear. They said the cuts were strategic, focused on eliminating non-essential bloat. They even stated the goal is to drive the OPEX number even lower.
Even lower, wow.
Yeah. And the focus remains on leveraging technology like that AI inspection tool we talked about to handle the scale, rather than relying on human capital, which suggests, the bulk of those cuts were likely in roles or processes that the new tech stack is basically designed to absorb or replace.
Okay, so operational efficiency is absolutely key, regardless of the housing cycle swings. But they still depend on people actually selling houses, right?
Fundamentally, yes.
What signs are they seeing that the macro market might be improving, even slightly, to help them hit that volume goal?
They mentioned early signs of stabilization. Not a boom, but stabilization, primarily tied to interest rates easing a bit, hovering now in the lower sixes maybe.
And what specific indicators did they point to?
Things like more sellers jumping into the market, being more willing to engage. Also, early signs of purchase loan applications going up and maybe increased showing activity in certain segments. Again, this isn't a roaring recovery by any means, but it's enough stabilization, management seems to think, to make them more willing, more able to buy homes themselves.
Right, gives them a bit more confidence to acquire inventory. The Q4 guidance, though, it reflected some caution, right? Anticipating seasonality.
It did. Revenue expected between $100 and $125, homes sold between $300 to $350, and adjusted EBITDA was expected to remain roughly in line with Q3 levels, which, remember, was a loss of about $4.6 million.
So, holding the line on losses during the slow season.
Yeah, that guidance really shows financial restraint. They're prioritizing expense control during that seasonal slowdown, keeping the focus laser sharp on hitting the strategic goal that 1,000 transactions sometime in 2026, regardless of the holiday dip.
Okay, finally, let's look at the leadership shift. They announced a new COO, Chris Carpenter. This is fascinating because his background isn't traditional real estate. It's transformation and integration at places like Warner Media. What does hiring someone like that signal?
Well, it signals a prioritization of, I think, platform integration and customer flow over just traditional real estate expertise. His mandate doesn't seem to be about underwriting homes better. It's about making the internal machine run seamlessly, connecting all these different pieces.
So what's his focus?
It looks threefold. Number one, improving conversion across all those channels we talked about. Number two, preparing the company for smarter, tech-enabled scale even beyond the initial 1,000 transaction goal. And number three, really strengthening the connection between technology, operations, and the overall customer experience, making it feel integrated.
Okay, so if we connect that to the bigger picture, how exactly do these four pillars, cash offer, home pro, renovate, direct plus, how do they work together as that big wheel tied together the CEO described? What's the flywheel effect they're hoping for?
Yeah, the integrated model is really designed for internal cross-pollination and, importantly, capital efficiency. Here's a powerful example they gave. Direct Plus actually helps conversion with Renovate.
How so?
Well, when those mid to smaller Direct Plus partners, the ones buying houses from Offerpad in bulk, use the platform for sourcing homes, they often don't have their own large-scale renovation capacity.
Ah, I see.
So they end up utilizing Offerpad's renovation services as well.
So the outflow channel also generates service revenue.
Exactly. That means the Direct Plus channel, which is critical for getting inventory off their books, is also generating high margin service revenue through Renovate. This kind of integrated ecosystem is designed to be more resilient and ideally subsidize the costs of customer acquisition across the entire platform, not just in one silo.
That's definitely a comprehensive strategy. Risky maybe, but comprehensive. So the core takeaway for you listening has to be this. The path back to profitability for this innovator, it doesn't rely on passively waiting for the housing market to magically recover. It relies on a massive, active internal adaptation.
Absolutely. The strategy really defines 2026 as the year of operational execution. It's about diversifying to that 50% plus asset light target, yes, but also achieving scale through technology, like that AI-driven picture recognition, to support those really aggressive cost reductions. It's a fundamental shift away from market timing risk towards, well, operational execution discipline. Can they actually pull it off?
So you now have the full playbook, essentially, for how a major real estate company plans to manage capital, volume, and costs in this really uneven environment. The key operational challenge now is just ensuring that those aggressive expense cuts and the rollout of complex new technology actually translate into hitting that 1,000 transaction goal consistently. It's all about execution from here.
And this really raises an important question, maybe for the future of the industry. If AI-driven picture recognition can automate the complex, subjective process of estimating renovation costs and property condition, streamlining the price offer, what's the next manual, high-variability process in the home transaction lifecycle? Perhaps the appraisal process itself that this industry will inevitably automate.